Not going back.
We're not what?
When y'all understand that y'all not going backwards. Y'all will not go back.
We're not. Okay.
I promise you. If y'all do go back, I'll give y'all personally $1,000 each.
Wow, you that confident, huh?
I'm that confident. Now it may be in installments over. But eventually y'all get it.
Right. Oh gosh. Okay.
When I come around, got the whole thing wobbin', wobbin', wobbin'. When I come around, got the whole thing wobbin',
Like, I guess you're doing your thing. So
Yeah,
man. So
okay.
and I'm just giving you so we can really get a sense of the dollars amount. Can you tell them about that FedEx trade? That FedEx trade you did?
Oh, February 2016, I made a speculative trade off of earnings reports. I don't know if you guys are actually familiar with earning reports. Are you?
No, I'm not.
Okay, so pretty much earnings reports comes out every quarter, and what it does, constituents or the shareholders information about where the stock and where the company is actually going. And during that time, on that particular date, the stock can either shoot up a good percentage or shoot down a particular percentage. So playing options during that particular during that time frame can get you a lot of money, or you can get a lot of money depending on how much you leverage. So at that time, I felt comfortable.
What do you mean by leverage? How much money you just risk?
Okay.
Yeah.
Okay.
So and so I leveraged $300 on a call option, and I bought 10 contracts for 30 cents because FedEx was trading pretty cheaply at that time. I told myself I was going to hold that position through its earnings report.
So that's the contract itself. The call option was worth 30 cents, right?
Mm-hmm.
He bought 10 contracts. So we know that one contract equals 100 shares. So if you bought 10 of those, he purchased, he had 1,000 shares. So 30 cents times 1,000 is $300. Go ahead.
Okay.
What's the fee? The fee at that time was about $5 or $6?
Like $5.
Yeah, it was $5.95. But anyway, so I held that particular position through its earnings report, and FedEx actually shot up. And so I was actually able to sell that same contract in that morning, the day after, first 30 minutes of the trading session for $5. So I had 10 contracts, which was 1,000 shares for $5. So I sold it for $5,000. So I made I made a profit of just say $4,700 minus the fees. But it was like 46, just say 46.89 or something like that. So
And you only paid $300?
yes, ma'am.
Oh my God. So
right,
so that's called a bullish.
Yeah.
There you go.
Yeah.
There you go, man.
You gotta go, Mel.
There you go.
Yeah, so the particular sentiment of the stock FedEx was bullish, and I felt as though it was bullish. I just had a hunch, and I felt comfortable with risking and leveraging $300 to make a good profit, and I made a good profit, and the contract was in the money. It was definitely in the money.
Good segue. So that's why.
Yeah.
So that's what I'm saying. In the money. So essentially, so he bought the. Okay, let me do this. Don't lose it, Marcus. So FedEx. FedEx. Stay with it, Marcus. You get it. So FedEx. What was it trading at? Let's say it was trading at $140.
It was about. Well, I bought the contract 30 cents, 10. It was trading, I think, like at 145. And I think I bought the contracts for 155 and then it appreciated to 160.
Okay.
It appreciated. Now I did buy the contract the week before.
Okay.
I bought the contract the week before. So I let it sit.
So let's say so let's say this. So before he made that decision to buy the contract, right? That call option, FedEx was trading at $145. Right?
Mm-hmm.
So So Mel, like as you mentioned, he believed that the stock market was going to go up. I mean that stock was going to go up based off on different factors. So he was considered, like you said, bullish on that position, right? So
Right.
if you're bullish, then you're going to buy what? A call option.
Okay.
Let me get rid of this. Hold on. All right. Okay, I'm sorry about that.
I'm trying to change.
Yeah, I'm trying. All right. I'm gonna make the markers as green so we can stay with the markers. All right, green. All right. Like you said, he was bullish, right? So the contract that he purchased. So the contract he purchased. Purchase contract. What's FedEx?
FDX.
FDX. So the contract he purchased. Let's see. I'm put option description. Option description. So the option description, I think it's FDX.
It is FDX.
So the option description was FDX, right?
Mhm.
Hold on. Let me make sure I get it right. And of course, whatever I'm typing, I'll definitely send it to you guys as well. And then also the video, I'll send like the slide. So just in case you want to print it out and just read it and just make notes, I could just send that to you as well.
Yes, please. You said the video that we watched before coming to this?
Yeah, I did. It was like in the PowerPoint presentation format that I did it in. But I can, email the slides, slideshows to you.
Okay.
Yes, please. Thank you.
Okay. So it was a FedEx. The purchase date was around March. But we're gonna use this time period so it won't be no confusion, right? So let's say we did the same type of deal this year. So it's gonna be 2020 April. What's the expiration? The third. April 3rd. C. And then the contract was 30 cents. Right? Yeah. So you'll see this. You know what? Let me do this. Cause y'all be with Fidelity, right?
Yeah.
Okay. Okay. So I'm gonna use Fidelity so we can also get familiar with the platform that you guys gonna be using, right? So let me go to let me make this bigger. All right, this would be, I think this would be more effective. You think? Yeah. Strike prices. Thanks. All right. Okay. So just a quick recap. What is this called right here? What is the screen called?
What is this?
It has your expiration dates. It has the call on the left side. It has the puts on this side. You remember from the video what we call that?
I didn't write that down. That was the first screen on the call.
So
I don't think I wrote it down.
It's actually on the screen.
Let me see.
It says it on the screen.
Where's it on? Where you see it on the screen?
No, I mean one of the words that you're looking for is on the screen.
Oh,
Yeah.
it's on
I
the
see
screen.
bearish. I see the bearish, bullish, bearish.
Look under that.
It's
Trade in chain.
Trade in
Trade.
so this
trade
is
in,
this is the option pricing chain. To where
option price.
yeah.
Okay.
You remember that to where I broke down to where what the option chain looks like, as far as you have your calls on here, your puts on this side, your
Mhm.
price right here, and
Mhm.
the calls like Mel said, you're bullish, the puts you bearish. Yeah, so this
So
right here.
I wrote all down. I just don't have the actual name of what that page would be considered.
Oh, it's no problem, no problem. Yeah, so this is the option pricing chain, right? So it's gonna be this is like or since we all worked at the same place, this is gonna be y'all mainframe, y'all vantage, basically, right? The end all, and be all what's going on with the particular options, right?
Okay.
Let me
Okay. What's this called again? Let me write it down.
options chain.
Options chain. Okay.
Hmm.
Okay.
And then going back to here's the
Hold on, Marcus. Let me ask you something.
okay.
So in the middle where it says, I guess where it has the bullish and the green and the bearish and the red, does that signify something?
Yes, so with this with Fidelity active trader, let me put my drone tool. Where is it? Yeah, with Fidelity Fidelity active trader tool, you see me circling that.
Mhm.
This is a platform where it provides you with tons of like information to help and aid you in making decisions regarding to what type of option contract that you're going to purchase.
Okay.
With this particular, all trading platforms are not the same. So when I was looking through Fidelity, I was really impressed with their particular platform. So this right here that you're talking about, the ratio,
Mhm.
this is something that every firm don't have, but this is called the CP ratio, which is just C for call, P for puts ratio. It just lets you know the sentiment regard to the bulls versus the bearish, the bear.
Okay.
Yeah.
Mhm.
So right here, you can list to see it's your calls and puts, which is outlined right here,
Mhm.
Okay.
right? Your strikes, right? Meaning that these particular prices in the middle are your strike prices. This column right here. You can see more than 5 if you prefer, but if in this example we just did 5. And here, when you see days and the weeks, these are um, your expiration dates.
Okay.
Oh, okay.
Hmm. So what I like about Fidelity, it lets you know options typically are monthly, but you have some weekly options, right? So, but with Fidelity, they let you know if it's weekly because of the W's. When you see a W next to it, it's a weekly option, meaning that the contract will expire that week. So the week of April 3rd, which is this Monday coming up, these contracts
Mhm.
are going to expire within 5 days,
Okay.
Okay.
right? So the week of April 9th, right? These contracts are going to be expiring in 11 days, so 2 weeks, right? And then the last one, the April 17th, you don't see a W next to it. It's not. It's a monthly option, right? And
Okay.
and monthly options expire the third Friday of each month. And once we start talking more and digging deep, when we get to the advanced level, that particular information is going to be is very vital as far as how the position may affect the price of the option. The psychology, like at the end of the day, when it comes to investing, is all about psychology. And it's crazy. It's like, how can I? It's all about pure psychology, and that's just my opinion. And I believe, but because I've read different books, spoke to different people and actually done it, it's all about psychology, how things work. So, so if you're good with, reading stuff and interpreting things, then you'll be very well in option trading. So, so we did all that. Let's see, anything else?
Yeah, can we go back to how his thing, like, can you break it down like you were about to with the FedEx thing and how you, okay.
All right, let me, what is it? All right, so the stock was currently priced, if I can get to it. So his sentiment that he was bullish, so he purchased a call, right? The option description was FedEx, year 2020, right? Expiration month is April. April. Expiration day is the 3rd. It's the day it's going to expire. It's a call option. That's what that C represents. And the 00 represents 30 cents.
Okay.
Right? So that's the option description. So when he purchased the contract, for 30 cents. Contract purchase. He bought 10 contracts, right? So how many shares would that be?
I thought we said 300.
No, if he bought 10 contracts, how many?
About 10. It's about 30 times.
Wait, if he bought, would it be if he bought 10 contracts times 30?
Yeah, he bought 10 contracts. So how many shares did he actually buy?
Oh, because it's 100 a share, right?
Mm-hmm.
Would it 1,000?
Yep.
Okay, so each share it's always going to be in the increment of. Sorry.
1,000.
When you're doing it like this, it's going to be in the increment of 100.
Correct.
Okay.
Can it go up to higher than 100, or it's always at 100?
Always at 100. That's how they sold. That's how they sold.
Okay.
All right. And make this a little bit smaller. All right. All right. So now his total cost, if we do 30 cents times 1,000 shares, is $300.
$300.
And there will be some, commission that you have to pay to execute those shares, but they are usually 65 cents per contract.
Now,
They're now 65 cents per contract. So say if you had to include those shares, you'd do $300 plus 65 cents per contract. You got 10 contracts. Now you're paying $6.35 for a total cost of $365.
Okay.
That's your
And the
total.
commission the commission is a given, right?
It's a give. You can't. There's no way around it. And for Fidelity and typically all brokerage now is 65 cents per contract.
Okay.
All right.
Mm-hmm.
So this is total cost. And let me do this plus 65 cents, which is commission. Times 10 contracts. Okay, yeah. If I send this to you, would this confuse you? Yeah, hold on. Yeah, it's confusing me a little bit. Hold on. All right. I do it like this. Plus. Yeah, like that. All right.
And it'd be 650, won't it?
Yeah, I'm sorry. I'm tripping. 650. Right. So total cost equals $306.50. So that's your I'm gonna mark this as red because this is when we spending money out.
Okay.
So if I send this to you, would this make sense?
Yes. Now that we've kind of discussed it.
Okay.
Mm-hmm. Yep.
All right. Let me do this. Just in case, purchase. All right. All right. So now, someone has to do all this over. So now he sold it. So he sold it. What did you sell it for? $5. So $5, which is now $5,000. Right. Again, when you exit the trade, you still have to pay the commissions when you sell as well.
Okay.
Right. So it's still gonna be that $6.50. Total gain, which is gonna be green. So what's that? Yeah, and the craziest part is, I remember he called me because he how black people get excited. He called.
Right.
He called. He called. I was excited when he called. He said, "Man, you won't believe what happened." I said, "What?" He said, "Yeah, man. Also, the contract went up as high as to $10."
Wow.
Okay, so maybe I don't know if this is a good question. So,
And JJ can answer it.
okay, so let's see if I can word it right. Okay, so did you sell it early in those 5 days before the expiration date? Or,
Yeah,
I mean, did you just,
I sold it the day, I think it was actually a Tuesday. So the expiration date of that week was that Friday, but I sold it on a Tuesday, and I sold that particular contract for that price.
okay.
Yeah. So
And,
you
And
know
you said it went up to $10, like maybe later on before the expiration date?
that day, that day it went to $10.
Oh, the day it went up to 10. So had
Yeah.
you waited a little longer,
that was my question.
for the
Yeah.
double.
If I waited a little longer, I would have made more money.
Wow.
Yeah.
And remember, with option expiration date always going to be on a Friday, except so. Okay, I don't want to I don't want to confuse. Okay, option securities like companies like Amazon's and your companies, all the expiration is always going to be on Fridays. What's
Okay.
your ETFs? There may be some ETF that have 3 expiration dates in 1 week because the amount of volume and people participating and buying those particular contracts. But typically,
Okay.
your expiration dates for is Fridays, other than like certain ETFs. And the ETF I'm talking about is the SPY. Remember we talked about it last time. This S&P 500 ETF.
Mhm.
So yeah. Oh shit. What? What the? So this is his net profit.
That's his profit. And that's the money that he put in
Yeah.
and the commission.
Yep.
Wow.
Well, actually,
And
not.
all this occurred in a week?
All this occurred. I bought it Thursday of the previous week, and then I sold it Wednesday. It was actually Wednesday. Wednesday of the fall.
Wow.
Oh yeah, it
Fall.
happened. Yeah,
Wow.
it happened Friday.
Okay. Good stuff.
Mm-hmm. Hold on. Let me do it like this. All right. Minus. I hear you. Is that soprano?
Marcus, guess what? In my new group, they put me as an alto.
Ugh. Ugh. You got the personality of one though.
Stop it.
But you can't be a little bougie at times, so you should be stuck in the soprano section.
Right. Soprano till I die.
Yeah, so this is what he brought. So I'm gonna put a double line. Do we have the double lines under here? Nah, they don't. They don't. I'm gonna put in bold so you know. So yeah, so that's really and plus minus taxes, of course you gotta pay taxes on it, of course.
Yeah.
But that's roughly what he brought home in a week. Mm-hmm.
Okay. And I know it don't always happen like that. You know, I know it could take some losses too.
Yeah.
No, it can go against you too.
Yeah, it can go. Definitely go against you, and it will go against you. But yeah, that's how that particular trade went for him.
Yeah. Okay.
So,
Now,
so let me just ask, so if it had started dropping, then you would have just sold it off.
yeah. So, okay. So when I mentioned in the videos talking about something expiring worthless, meaning that say if that trade went against him, so the value. Okay, let me okay, let me show you what's the in the money, right? So this example right here. Well, no, this is not example of in the money. Okay, let me just put this away. I don't want to confuse nobody. All right, so to answer your question, Mel, if the trade went against him, so his contract was worth 30 cents originally, right? If that contract was to decrease to say like 15 cents, he would have lost half of that. He would have lost half of his money. So he could so he could sell it and just lose 50% of it, or if he let it go through the expiration time period, that date, then he would have lost the whole.
Right. Okay.
Okay.
Yeah, all the
Right.
three. So you either lose the whole $360.50, or you lose $150 or some change, and that's where the risk management comes into play. So typically, give example like our type of strategy.
So
Yeah,
okay, so I have another dumb question. So okay, so let's say that JJ decided to have waited until Thursday and it had dropped. I guess you just answered that question.
Mm-hmm.
It would have been the same situation. So
Yeah,
that's where the risk is involved. You know, whether you decide to wait until the end of the week, or I guess that's just your call.
Yeah, and I'm just gonna keep it real and 100. With options, you have to be right that the contract moves. You have to be right that the stock moves. You have to, you have to be right on all. You have to be right on every single thing for it to work.
Oh, damn.
So if you see it, you better go ahead and strike right there, basically.
Yes.
Yeah.
Yes.
So
yes.
so we are the believers. We don't wait to see what happens, because we don't have
Right.
time.
No, I've done that.
Yeah, and I'll give you an example. We was purchasing Nike, right? We was going to play an earnings call on Nike, and I did this myself. I played an earnings call on Nike, and I was still at MetLife at the time. I played the earnings call. I bought a call. I think it was like at 45 cents, because I was so hype of his FedEx trade. I'm like, oh my God, it's going to work for Nike, and I wasn't all the way educated as I was now. And looking back, it was a dumb trade, but it was the smartest trade of my life, right? Ooh, that was deep. It was a dumb trade. So I was so excited. I told my dad, I told Jeanette, I said, yo, we about to get some bread. And they had a great earnings, the same thing as FedEx, but the stock value decreased in value. And I'm like, why did it decrease if they had great earnings and stuff like that? Because their guidance as far as in the future wasn't too promising, and that whole industry itself was kind of, not particularly going to be doing so well. So I lost $362 within a week, right? But I when the earnings came out, I still had time to get out the trade, and not lose all my money. But I was saying, okay, it's going to go up. It's going to go up. It's going to go up. And by the time Friday came, ain't nothing was happening.
Wow. Okay.
That when we say take your money or set something in place where if you see, like, if you say to yourself, if I see a 7% decrease in my option contract, I'm getting out of the contract.
Makes sense. Okay.
And it's gonna be hard to where you're gonna get out of it, and then 2 hours later it jumps up 50%.
Yeah.
And that happened. It happened like too many times. It's like, but at the end of the day, it's all about protecting and protecting, really thinking things straight. And then it also said, well, why did I jump to conclusions, right? Or why I didn't stay in it long enough? Like, if I did my homework, if I did my technical analysis, and I was right, it was why it's those type of games. Because unfortunately with options, you have to be right by the direction, and you have to be right by the timing. For me personally, and JJ can attest to it, I'm not gonna lie, I'm gonna pat myself on the back. I am always right about the direction and what's gonna happen. I'm always right. because I look at my technicals and I go hard with my technical analysis, and I'm just really good at that. My issue is the execution of the timing of when it's going to happen.
Okay.
Because I have to be right on the direction of the contract, and I have to be right on the timing because I only have a certain amount of days,
Right.
a certain amount of weeks, right? So,
Mm-hmm.
I've had trades to where, prime example, just last couple of weeks, like last month for the whole, I contacted JJ and said, hey, I'm thinking about buying this car. I was I thinking about it. I think I bought it. Yeah, I bought it. No, it was Chipotle. I bought Chipotle, right? Option. I knew the direction was gonna go up. I knew everything. So when I bought it for a weekly option where it expires that same week, I bought it for I think like $1.65, right?
Mm-hmm.
I was wrong. I lost the whole $1.65. But I knew the direction was going to be crazy. That following week, that Monday, the stock jumped up 80 points.
Mm.
Wow.
And that contract, I know for sure would have definitely been worth about like $7, right? I know it would have been worth about $7. But that's the whole thing with options. And I'm not trying to scare nobody, but it's just reality. You have to be right with the direction, and the most important thing is the timing, because your directional play for where you think it's going to go may be right after your expiration date.
Now,
So
can you
you
go back?
jumped in.
Can you
Oh,
go
I'm
back
sorry.
in?
Hello?
Can you hear me, Marcus?
Yeah, I can hear you.
Okay, so you got out after expiration date. Can you go back in like the following week? Can you go back into that same
Yeah, well, you can
Yeah,
go.
but it'll be higher.
It'll be
yeah,
once.
you got to pay more.
Yeah, my contract expired on that week, but the new
Right.
contract it's definitely higher. So the contract is now worth $7.
Okay, I got you. Okay,
So
I
So
got you.
you went in a week too early, basically.
to be a week, yeah. When if you're looking at the expiration weeks, yeah, I went in a week too early.
Okay, so
Okay.
that's the risk. Okay, so that goes back to the risk. Okay.
It'll go back to the risk. But what we definitely learned with these options, what we definitely learned is that when we buy, I'm sorry, hold on, right quick. This is my dad. What we definitely learned is that buying in the money contracts are a lot less riskier, and giving us the time, giving us enough time to let our trade. Jesus Christ.
Your dog sound big.
Yeah, it's a little rock wild.
Hmm.
Yeah. The thing is, what we learn is that we have to give ourselves enough time to let our directional and our trade work for us, our technical analysis. So I'm not kidding you. We are right. Like over 80-90% of the time, as far as the directional and what it's doing, everything. It's the timing of when the option catch up to what we're thinking. So
Hmm.
you go in and buy options, it's very risky to buy an option contract that expires the same week that you bought it, because you're not giving yourself enough time. So if you buy the option contract further out, like say like 3 weeks to a month out, it's going to be a lot more expensive. It's going to be a lot more expensive, but you're allowing yourself for that trade to matriculate. And then also the further you buy your call, um, the less money you lose over those few weeks until the expiration date. Because what I'll be doing the video on is the Greeks and on how that plays into the option premiums and stuff like that. But we definitely not gonna get into that today, because that's something that's very important as well. So it's a lot of it's a lot of factors that goes into is involved with selecting the right option.
Gotcha.
So, Marcus, do you and JJ suggest that we get or look into like the earnest reports that come out quarterly? Is that something we subscribe to?
I told JJ, India, she don't play no games. She don't play no. she hit me up. I was joking with Mel about you, India. She hit me 2 days ago saying, "Oh, we need to buy because the market's going up." She's ready to buy.
I am smooth as a cucumber. I'm just gonna go with the wave. Marcus,
I mean, but to be honest, like, and I'm not just saying this, but when we first started, India, it was more like JJ, and Mel was more like me. When I say that in with love and affection, because the day we learned what an option was, this fool went ahead and bought an option the next day. Didn't know what he was doing.
I gotta listen to that analogy 3, 4, 5, 20 times, Marcus.
I mean, literally, he bought the option the next day.
With that being said, he's telling the truth. The thing is that it was risk management with my portfolio, because again, like I said before, I already had established long-term positions, I already had capital in my account. So I felt, hey, let me take this particular. So with playing earnings reports, it can be very fruitful, and it can also go against. So if you're actually willing to lose $300, $400, $500 or $5,000, because that's happened to me. So so it's up to you.
But that's him. And with me, I've learned there's option strategies to where you can take advantage of earnings to where you can buy a put and buy a call at the same time, right? And you have to understand, you have to know that, okay, can this stock move up like crazy to increase my value in either direction? So that's what they call a strangle option strategy, to where you buy a call and you buy the option at the same expiration date, because you're betting on crazy momentum movement within that stock price. So there's different strategies you can play, and that reduces the risk. But that's like more so kind of like a intermediate type level. Don't want to confuse somebody. And then also you can do some debit spreads to where you can.
Cut it, man.
You can do some debit spreads as well, but that's down the line, once you get familiar, as far as you actually done a couple of trades and you actually see and understand what's going on.
Okay.
But for your answer, India, as far as right now, don't pull no earnings reports. And you could just watch. I will encourage just to this month, especially this month, because what's going on with the coronavirus, because that's what a lot of investors are going to be paying attention as far as his earning report. So they're not going to care what happened last month. Whatever you did last month, that's okay. That's good and great. They're going to be caring about the guidance going forward. What y'all going to do, right? And so if the guidance is positive and investors feel comfortable and confident within the market and stuff like that, then the stock may increase, right? But if their guidance is not all the way there or something like that, they're gonna say, hey, we can't rock with y'all until everything ease over, cool off.
Okay.
I'm
gonna slow my roll. I'm gonna cool off. I'm gonna slow my roll.
This it just
Mhm.
feel off right.
Yeah.
Because trust me, when you pull the trigger, when you start pulling the trigger, you're gonna I want you to feel like confident, comfortable, and pulling the trigger, regardless if it's a win or a loss.
Right.
Yeah, and we kind of in a weird type of as far as us talking about this because it's like a crash because I want you guys to start taking advantage like as soon as possible. But I can't have y'all out there just like Forrest Gump on that shrimp boat the first time.
Right.
Right.
Been there, done that. So
Yeah.
yeah, I know.
Okay.
So do you feel like after the stimulus package goes out that there will be a little bit of momentum in the market?
That's a great question. So what's happening? Are you guys familiar? Are you guys familiar with quantitative easing? Easing, QE.
No.
Okay.
Oh.
So what's happening is that the Federal Reserve Bank, the Federal Reserve, are trying to stimulate the economy by purchasing, bonds from different companies, as well as now what they're doing is injecting money into the marketplace. So the government is slowly buying the market. I mean, it's slowly buying stocks. So Andy, when you mentioned that 2 days ago, oh, the market's going up 2 or 3 days, that's kind of I hate to use this word, but that's the first word that came to me. That's kind of fake news because that's the government buying.
Okay. Okay.
So that's not really true investors feeling confident in the market. They trying to buy the market so investors can feel comfortable to invest back into the market.
Okay. That makes sense too. That makes
Mhm.
sense.
Yeah. So, but a lot of people and if you don't know that, if you don't kind of hit to that little strategy of what they're doing, then people would think, oh, the market is rebounding. Let me put all my money back in the stocks.
And that's kind of what they probably want some people to do.
Yeah, exactly. But from the and I'm not trying to use technical terms, but from a fundamental standpoint, regarding to the market, it has not it's not has not yet not say rebound, but it has not yet really calmed down. Because to be honest, the coronavirus was not the reason or shouldn't have been the reason for the market to do what it needs to do, because there's a lot more stuff that is going to affect the market as well, but it just hasn't caught up. It's just been delayed. So so it's a lot more that can happen besides the coronavirus. So after coronavirus, that doesn't mean everything is all good and great. It's just for me personally, it's just a precursor for the next.
Oh, okay.
hmm So
Wow. Thanks, Marcus. This is some good stuff.
yeah, man, the hustle. It's like once you understand the hustle, it just you see it and you can just. I mean, it's just a beautiful. I'm always saying it's a beautiful thing, but I mean, it's just so beautiful. You're in the know, but you're not relying on somebody to tell you. You just what we do pay attention to like to the Fed Reserve meetings, right?
Mhm.
We do look at the each city had like the Federal Reserve Bank, like for the city of Atlanta. So so like that. So those are great resources to where if you read the white pages, what they call it for the Federal Reserve, no, the white book for and that's not racist, but it sounds kind of racist. The white book
Okay.
the Federal Reserve, they actually explain what's going on in the city of Atlanta as far as where the mortgages, the interest rates, where they see economic improvement, where we see small businesses being affected in certain areas. So they give you the blueprint because at the end of the day, these are businesses that are going to be going after loans and stuff like that, and even cities, loans and stuff like that. So they have a lot of information out there, but it's not going to be on YouTube. It's going to be on a page where you have to read it.
Mhm.
That's
Okay.
what people, a lot of people, get the disconnect. And even prime example, Warren Buffett, he's every month every month, every year, he sends out Berkshire Hathaway shareholding reports that talks about what happened that particular year and what they're looking to do. And it's a wealth of information that you could just read and say, oh, shoot, like that he believed. I mean, I believe in one aspect, I looked at the 2008 shareholders meetings report that he sent out to Berkshire Hathaway. And, you know, that was with the financial crisis. I wanted to see what were his thoughts. And this was before, he sent before it even happened. He said, we see a lot of decline in the bond market and in the housing. So we're reallocating our funds away from the housing and from the bonds and put into safe havens like cash and stuff like that, because we believe there may be a bubble pursuing, but we don't know what time.
Wow.
Okay.
Yeah. So, you know, I kind of just read and we kind of just read and just, you know, study those who've been around for a long time and been doing it longer than us, and who has the resources as far as systems and, you know, information. That's how I gain, you know, a lot of my information and stuff like that. It's about, you know, reading what they talk about.
Makes sense.
Mm-hmm. Yep.
Okay.
So now what theoretically I was gonna on the next video I was gonna do more so of the options going into greater detail, but as far as with the Greeks and the risk management, because that's still important. But I think the most important thing is to educate and teach y'all how to, you know, read a stock chart and kind of get into the technical analysis part of it. How to choose a company from a technical level and stuff like that. Because nowadays, when you choose these price movements in stocks, it's not really based off of fundamentals. It's based off the perception. That's where the market is. It's the perception, and then fundamentals will catch up. It's crazy. It's backwards than what it was back in the day. If you had a strong company in the earnings report and things of that nature, then you're a great value company. But nowadays, if you're not perceived to be great, then you're not great, regardless of how your fundamentals look.
Okay.
So when I mean by fundamentals, I mean by like their balance sheets and their financial statements.
Okay.
Okay.
So I'm just forewarned you, the technical analysis part. If you I'm not trying to scare nobody, but if you're not reading or not looking at it like every single day, then when we get on these type of calls, and then you actually start trying to trade, it's going to be very difficult for decision making because you don't know where to go. Finding the option contract is one thing, but realizing when to get the option and what company to get the option, and which direction to get the option, that's a whole different ball game. Because again, for us, we got to be right on the option contract itself. We got to be right on the direction, and we got to be right on the timing.
Okay.
Mm-hmm.
So what do you suggest in the meantime that we do? Just kind of go in and just play around, look around.
Oh no, don't play around. Don't play around with no money now. Don't play around with no
No,
money.
I'm not talking about.
Oh.
I'm not talking about with money, but I'm just saying like